Last year, a new form of digital money quietly processed more than $34 trillion in transactions. That's not a typo trillion. This payment network operates 24 hours a day, across borders without traditional banks controlling every transaction. And the most surprising part, many people still don't fully understand how it works. We're talking about stablecoins, a rapidly growing type of digital currency that is now attracting the attention of governments, banks, and regulators around the world. According to data from Visa, stablecoin transaction volume exceeded $34 trillion last year, while the total market value of these digital assets has grown from less than $50 billion to nearly $300 billion in just 5 years. But despite all the hype, one big question remains. What exactly is a stablecoin? And why does it matter for the future of money? To understand why stablecoins are suddenly everywhere, we need to go back just a few years. When cryptocurrencies like Bitcoin first appeared, they introduced a new idea, decentralized digital money that could move across the internet without banks. But there was a major problem. Crypto prices were extremely volatile. A coin could rise or fall 10% or more in a single day, making it difficult to use for everyday payments or financial transactions. That's where stablecoins came in. Stablecoins were designed to solve this volatility problem by linking their value to traditional currencies, most commonly the US dollar. Instead of fluctuating wildly, a stablecoin aims to maintain a fixed value of $1 per coin. Popular examples include Tether and USD Coin. These digital tokens allow people to move dollar-equivalent value across blockchain networks instantly. And that simple idea has created one of the fastest-growing sectors in financial technology. So why are stablecoins growing so quickly? The answer lies in how inefficient traditional global payments can be. Sending money internationally through banks can take several days and involve multiple intermediaries. Every step in the process adds fees, delays, and complexities. Stablecoins change that equation. Using blockchain networks, stablecoins allow money to move almost instantly, often within seconds. There are no banking hours, no weekends, no holidays. Payments can move 24 hours a day, 7 days a week, anywhere in the world. This capability has made stablecoins incredibly useful for international trade, remittances, crypto trading, decentralized finance. In fact, stablecoins have become the primary settlement currency in the crypto economy. Instead of converting back to traditional bank money, traders often move their funds into stablecoins during market volatility. That means stablecoins have evolved into something much bigger than just a crypto tool. They are becoming a new layer of global financial infrastructure. As stablecoins expanded, governments and regulators around the world began to notice. Because if billions or even trillions of dollars are moving through digital tokens, regulators want to know who controls them, what backs them, and how safe are they. In 2025, the United States introduced new legislation designed specifically to regulate stablecoins. The US joined several other jurisdictions that had already developed stablecoin frameworks, including Japan, the European Union, Hong Kong, Singapore, and the United Arab Emirates. These regulations focus on key issues like reserve transparency, financial stability, consumer protection, anti-money laundering rules. In other words, governments are trying to ensure stablecoins operate more like regulated financial products and less like unregulated crypto experiments. But despite this regulatory progress, experts say there is still a major misunderstanding about stablecoins. A new report called the Stablecoin Toolkit, created by the Wharton Blockchain and Digital Asset Project, attempts to answer some of the biggest questions about this rapidly evolving market. The report was developed with more than 20 experts from academia, government, and industry, and its conclusion is surprising. Stablecoins are far more diverse and complex than most headlines suggest. In fact, the report argues that treating all stablecoins as a single category is a mistake. Some stablecoins function like digital cash, others resemble money market funds, and some operate more like financial settlement networks. Each model carries different risks, regulations, and economic roles. This complexity is one reason regulators are still debating how stablecoins should fit into the financial system. To understand the debate, it helps to look at how stablecoins maintain their value. The most common model is called a fiat-backed stablecoin. In this system, the company issuing the stablecoin holds reserves, usually cash or short-term government bonds, equal to the number of coins in circulation. If 1 million stablecoins exist, the issuer should hold $1 million in reserves. This system helps maintain the peg between the digital token and the real currency. However, not all stablecoins work this way. Some are crypto collateralized, meaning they are backed by other cryptocurrencies rather than traditional assets. Others rely on algorithmic systems that attempt to stabilize price through automated supply adjustments. Each design has advantages and risks, and history has shown that poorly designed stablecoins can collapse if market confidence disappears. So where does all this lead? Stablecoins could become the foundation of a new global financial infrastructure. Imagine a world where international payments settle instantly, companies move billions across borders without delays, financial markets operate continuously. Without traditional settlement windows in this future, stablecoins could function as digital cash for the internet economy. But there are still challenges. Regulators must balance innovation with financial stability. Companies must prove their reserves are secure and transparent. And the global financial system must adapt to a technology that moves money faster than traditional institutions were ever designed to handle. What happens next could shape the future of money for decades. Stablecoins started as a simple solution to crypto volatility, but today they are evolving into something much bigger, a potential new infrastructure for global finance. The real question now is not whether stablecoins will survive, it's how big their role will become. So here's a question for you. Do you think stablecoins will eventually replace traditional banking payments? Or will banks and governments take control of this technology? Let me know your thoughts in the comments. And if you enjoy deep dives into the future of the global economy, make sure to like, subscribe, and stay tuned for the next video.